Good evening and welcome to another episode of Night Markets, where each week I'll be giving you my perspective on what's driving markets, as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research for South Africa at SFO. So for a second week in a row, stocks experienced fairly mixed returns, with small caps and value shares continuing to outperform their large cap growth counterparts that have dominated the market for the majority of the year. The Nasdaq 100 Composite Index, which was heavily influenced by tech, has now underperformed the broader S&P 500 index and barely outperformed the small cap Russell 2000 index for the year to date, as at the close of trading on Thursday. However, we did see a recovery in large cap growth shares on Friday. This week was also notable for the S&P 500 index sell-off of more than 2% on Wednesday. This is actually the first time that has happened since February 2023, and the Nasdaq also experienced its worst loss since October 2022. So before we move on to markets, let's just quickly check in on the current situation in the Middle East. So over the weekend, after accusing the Iranian-backed Hezbollah group of a rocket attack on a football pitch in the Israeli-occupied Golan Heights, Israel actually declared on Sunday that it would retaliate with force against Hezbollah. Hezbollah denied any responsibility for the attack, but it was the deadliest we've seen in Israel or Israel-annexed territories since the initial infiltration of Hamas on October 7th. Prime Minister Benjamin Netanyahu actually concluded his visit to the United States prematurely, and he was anticipated to arrive in Israel later on Sunday and convene his security cabinet in the afternoon to deliberate on Israel's response. The United States, which has been spearheading diplomatic initiatives to try and de-escalate the conflict across the Lebanese-Israel border, condemned the attack as a horrific act. The White House issued a statement reiterating that the United States would continue to support the efforts to end these terrible attacks along the blue line, which must be a top priority, and that America's commitment to Israel's security was unwavering. The Special Coordinator for Lebanon also warned that the entire region could be engulfed in what they deem to be a catastrophe beyond belief if the attacks are further intensified. And then moving over to the markets, starting in the US, it's arguable that the economic calendar of the previous week presented an especially ambiguous depiction of the state of consumers and businesses in the world's largest economy. The Commerce Department reported on Wednesday that the number of new residences sold in June was only 617,000, which is significantly lower than the anticipated figure of approximately 740,000. This is actually the lowest monthly figure since November of last year. Additionally, we also saw the average selling price of houses decrease by approximately 4% from the previous year. S&P Global also reported that its manufacturing activity gauge unusually returned to contraction territory on the same day, with a reading of 49.5 and readings below 50 indicating contraction. We also saw this contraction for the first time since December. Nevertheless, data out on Thursday contained numerous positive surprises, which was probably one of the driving factors in the rally we saw on Thursday post the midweek low on Wednesday. In June, the Commerce Department reported that durable goods orders, which are traditionally used as a proxy for business investment, increased by 1%, the highest increase we've actually seen since March 2022, with the exception of defense and aircraft orders. In the second quarter, real inflation-adjusted consumer expenditure increased at an annualized rate of 2.3%, surpassing the 1.5% increase in the previous quarter, while weekly and continuing jobless claims decreased more than anticipated. The Commerce Department also announced Thursday that the economy expanded at an annualized rate of 2.8% in the second quarter, which was significantly higher than its initial estimate, and twice as fast as the first quarter's growth. Nevertheless, the majority of the increase was attributed to the expansion of government expenditure, as well as the accumulation of inventory. The Commerce Department's release of its core personal consumption expenditure price index, which excludes the volatile food and energy component on Thursday, appeared to be an additional factor in the rebound we saw in markets. The index only rose slightly more than anticipated in June, but it remained consistent at an annual rate of 2.6%. This rate's not significantly higher than the 2% target for the Federal Reserve's preferred gauge, so this would definitely be good news on the inflation front. The inflation data seems to solidify the likelihood of a Fed Reserve rate cut at its September meeting. And futures market concluded the week with a zero probability that the Fed funds rate would remain at its present level by the September meeting, as opposed to a slight probability the previous week. The yield on the benchmark 10-year Treasury note also ended the week marginally lower because of the positive inflation news. For the majority of the week, however, the micro appeared to be more important than the macroeconomic news we saw, as investors started to process one of the busiest weeks of the earnings reporting season. However, analysts polled by FactSet were still predicting a 9.8% increase in overall earnings for the S&P 500 compared to the same quarter a year ago at the end of the week. This is still a moderate increase from a 9.7% estimate the previous week. So after the dip early in the week, the major indices rebounded, with the Dow Jones Industrial Average ending the week in the green by almost 1%. However, the S&P 500 as well as the Nasdaq ended in the red despite the bounce we saw post the midweek slump. Then moving across to the Eurozone and the UK, the European equity markets also experienced a decline in the middle of the week, due mostly to the impact of negative earnings, especially in the tech and luxury goods sectors. Due to the negative sentiment that resulted from the substantial declines in Tesla and other Magnificent Seven mega-cap equities in the US, the tech sector was particularly vulnerable. On the political front, before the official opening ceremony of the Summer Olympics in Paris on Friday, President Emmanuel Macron issued an appeal for a political truce during the Games. The opening was somewhat impacted by the travel disruptions that were caused by some arson attacks on France's high-speed rail infrastructure on Friday, but the stock index did not appear to be impacted for the day. As the flash purchasing managers indices of the Eurozone continued to produce weaker than anticipated readings, expectations for monetary easing increased during the week. Consequently, core Eurozone government bond yields continued to decline. And for the first time since early June, markets have started to factor in a 50 basis points interest rate reduction from the European Central Bank for the remainder of 2024. The safe haven German sovereign government bonds were aided by a general risk-off stance in the markets. However, we did see the yields of French and Italian government bonds increased as a result of some of the political developments that continue to exacerbate their fiscal concerns. The new Chancellor of the Exchequer of the United Kingdom also declared that she would disclose the results of an audit of public finances by the conclusion of July. Press reports have suggested that the review could reveal a deficit of up to £20 billion, which could result in tax increases. The UK's economic data in general, however, has remained inconsistent. This has actually prompted speculation regarding whether the BOE will emulate the ECB and implement its initial interest rate reduction at its August policy meeting. Moving across to the Asia-Pacific region, Japan's stock markets also experienced substantial weekly losses, with the Nikkei 225 index and the broader Topix index both declining by 6% and 5.6% respectively. This was mostly due to the ongoing decline in the shares of the US mega-cap tech companies, with Japanese tech stocks also remaining under pressure. The profit outlook for Japanese exporters has also been further impacted by the yen strengthening for the third consecutive week, with the recent value of approximately 154 yen to the US dollar, a decrease from the 157 we saw at the previous week. The continued unwinding of short positions in the yen, as well as the increasing expectation of a narrowing of the US-Japan interest rate differential, were also factors contributing to the yen's strength. The yield on the 10-year Japanese government bond also increased from 1.04% to 1.06% at the conclusion of the week. Investors are also anticipating that the Bank of Japan's 30 to 31 July monetary policy meeting, in which the central bank would disclose its plans for the reduction of its substantial bond purchases and potentially raise rates as well. In order to prevent an unwelcome increase in yields, the tapering is expected to be gradual and occur in multiple stages. Pressure is also mounted on the Bank of Japan to increase rates once more in July in order to protect the currency and reduce the disparity between the domestic and foreign bond yields. And in terms of economic data, the most recent inflation report indicated that there was room for a potential rate rise. The Tokyo Core Consumer Price Index increased by 2.2% year-over-year in July, which was consistent with the expectations and an increase from the 2.1% we observed in June. Nevertheless, the inability to increase rates has been attributed to a lack of strength in private consumption in Japan. We also saw the July Flash Purchasing Managers Index data indicate that activity at Japan's private sector firms also resumed growth. Service providers were the primary drivers of the expansion, while manufacturers experienced a marginal decline in output. And then moving across to China, the central bank's unexpected rate cut seemed to fail to instill confidence in the economic prognosis, resulting in a decline in Chinese equities. The medium-term lending facility of the People's Bank of China was reduced by 20 basis points to 2.3%, marking the first reduction we saw since August of last year. The sequence of rate cuts indicated Beijing's increasing urgency to stimulate development in response to China's gross domestic product failures to meet expectations in the second quarter. In June, the economy was also characterized by a slowdown in retail sales, industrial production, as well as property investment, as evidenced by the latest data we've seen. The central bank is expected to continue to relax its policy and potentially also decrease its reserve requirements ratio in order to stimulate the economy. A bearish sentiment was also exacerbated by the absence of substantial policy initiatives subsequent to the third plenum, once in a every 5-year gathering of the Communist Party's highest-ranking officials. During the 3-day meeting that concluded on July the 18th, President Xi Jinping declared that high-quality development would be the primary focus of China going forward. However, he did not provide any specific policies, which disappointed those who had anticipated measures to stimulate consumption and also alleviate a lengthy property downturn. Consequently, the Shanghai Composite Index declined by 3.07%, while the blue chip CSI 300 was down 3.67%. And in Hong Kong, the benchmark Hang Seng Index also retreated by 2.28%. Then moving back to South Africa, locally, the only real market-moving news came on the inflation front. We saw a minor decrease from the 5.2% increase that we saw in May, as South Africa's annual consumer price index increased by 5.1% in June. The annual inflation rate for food and non-alcoholic beverages declined to 4.6%, which was the lowest level we've seen in 45 months. Inflation was lower in certain categories, including sugar, vegetables, and milk, while we saw some increases in others, such as heated beverages and bread. The annual inflation rate for housing and utilities also decreased to 5.5%, with only minor quarterly retail increases. The decrease in vehicle and fuel prices contributed to the cooling of transport inflation to 5.5%, which was a very welcoming addition. Month-on-month, fuel prices decreased by 4.6%, resulting in an annual rate of 7.6%. So subsequently, contrast to global markets, the All-Share Index ended the week higher by 1.5%, with the industrials and financial sectors both ending substantially higher during the week. The rand also ended the week slightly weaker at 18.31 to the US dollar. And then looking at the week ahead, the Federal Reserve, Bank of Japan, as well as the Bank of England are all scheduled to conduct policy meetings this week. These are all expected to be significant events for markets. The week's policy statement by the Fed will be the subject of particular intense scrutiny, as markets are presently pricing in an 88% likelihood of a September rate cut in response to a rise in the unemployment rate, as well as signs of cooling inflation. The inflation data released on Friday underscored the expectation that the U.S. Central Bank will establish the groundwork for a September rate cut during the week. Additionally, U.S. employment reports scheduled for Friday will also be the subject of attention. The non-farm payrolls report will be subject to increased scrutiny by investors as they attempt to determine whether the labor market's recent indications of cooling has actually persisted in July. Big tech earnings are also set to continue this week, and any disappointments could potentially further roil markets already on edge amid worries over stretched valuations. Microsoft is scheduled to release earnings on Tuesday, followed by Facebook on Wednesday, and Apple and Amazon on Thursday. So as always, we like to end off with an interesting investment idea we've been discussing during the week. We believe with the recent slowdown in inflation in the US, as well as a cooling off of the very hot labor market, that the Fed put is pretty much back in play. We still believe the shorter duration bonds in the US yielding close to 5%, that it will also be a good hedge should the market start to sell off further. Thank you for joining me for another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 p.m. Let's start the conversation.